In recent weeks, large XRP transfers have once again captured the attention of the crypto market. On-chain data shows millions, sometimes billions, of XRP moving at once, yet the price often remains surprisingly stable. This has raised an important question. Who is really selling XRP and where are these sales happening? According to crypto analyst and Digital Ascension Group CEO Jake Claver, the popular narrative blaming Ripple's escrow or retail panic selling is deeply flawed. Instead, Claver argues that most large XRP sales are happening quietly off the public markets through the over-the-counter desk and dark pools. So in this video, we are going to break down where these large XRP sales occur, why don't they crush the price, and what this means for XRP's market structure and future price behavior. So, why do large transfers look different from normal selling? Market data consistently shows high volume XRP movements that don't match Ripple's escrow release schedule or typical retail trading patterns. Under normal circumstances, selling this much supply on public exchanges would cause sharp price drops, heavy volatility, and visible order book pressure. But that's not what we are seeing. Instead, XRP often shows minimal price reaction, even during periods of intense on-chain activity. This disconnect has forced analysts to reassess how XRP liquidity actually works. The key insight is this: movement does not always equal market selling. Large holders can move XRP without touching public exchanges, meaning the price remains insulated from immediate shocks. This challenges the assumption that every large transfer represents fear, dumping, or loss of confidence. So, where do most large XRP sales actually happen? According to Jake Claver here, the majority of large XRP sales are not happening on visible exchanges. Instead, they occur through OTC desk and dark pools, especially mentioning Falcon X and Kraken's dark pool. Claver stated clearly that large XRP sales aren't from escrow or retail, but rather from early investors and hedge funds reallocating massive positions anonymously. These private venues allow buyers and sellers to transact without exposing their orders to the public order book. This matters because public charts only show part of the story. When XRP changes hands in these private environments, the blockchain records movement, but the exchange price barely reacts. So, what are OTC desks and dark pools, and why do institutions use them? OTC desk and dark pools exist for one reason, and that's scale. Falcon X operates as a digital asset prime brokerage, servicing hedge funds, family offices, and institutions that need deep liquidity with discretion. Kraken's dark pool works similarly, matching large buyers and sellers away from public exchange visibility. These mechanisms help institutions avoid slippage, protect their strategies, and prevent front running. Selling a massive XRP position on a public exchange would immediately push the price down, costing the seller millions. OTC trading eliminates that risk. This explains why XRP can experience heavy on-chain movement without heavy price damage. The trades are structured, not emotional, and executed with long-term portfolio management in mind. So, does this mean XRP selling pressure is being misunderstood? Yes, and this is one of the most important takeaways. Many traders assume that visible price stagnation during high transfer activity means manipulation or suppression. In reality, it often means liquidity is being managed efficiently behind the scenes. OTC transactions don't signal panic. They signal rotation. Every investors may be reducing exposure while new institutions quietly accumulate. This is a neutral to constructive market behavior, not a bearish one. The absence of visible selling does not mean inactivity. It means the activity is happening elsewhere, outside the emotional noise of retail markets. So, how does XRP's global liquidity enable this behavior? XRP's global liquidity network makes this type of large-scale private trading possible. The asset trades across numerous regions, currencies, and pairs, allowing supply to shift hands without overwhelming any single market. This structural advantage helps explain why XRP has repeatedly absorbed large volumes without sustained breakdowns. Ownership changes, but the market adapts. Liquidity remains intact. This is not a fragile market. It is a distributed one, capable of handling institutional scale flows. So, why are personal controversies around Jake Claver not the real issue? Some members of the XRP community criticize Jake Claver over past price predictions and allege business disputes. These issues are personal, contested, and separate from the data itself. What matters here is not who is speaking, but what the on-chain and liquidity data shows. The mechanics of OTC trading, dark pools, and institutional liquidity are well-established facts in financial markets. So, what does this mean for XRP's market structure going forward? If OTC desk and dark pools continue to handle a significant share of large XRP transactions, then public price charts will never tell the full story. XRP may appear quiet, stagnant, or suppressed, while massive reallocations happen quietly in the background. This suggests XRP's structure remains resilient. Supply is not being dumped recklessly. It is being absorbed, rotated, and redistributed. And finally, my own personal opinion about this is that this development is quietly bullish. Markets that support institutional scale transactions without chaos are signs of maturity. XRP's ability to move large amounts without collapsing indicates depth, not weakness. While price action may frustrate short-term traders, long-term investors should recognize this as a structural evolution. XRP is behaving less like a speculative asset and more like a liquidity instrument designed for scale. The real story isn't where XRP's price is today. It's how the market is learning to handle size. And this finally ends our video. Thank you very much for watching and see you on the next one.